value of the company. So here we have some projects, two projects. I have A and B here. $100,000 is spent in project A, $200,000 in B. There are cash flows. Here are discount rates. And you can plug these into your capital budget technique spreadsheet, and you'll end up with the solutions that we see here. We want to go through and talk about the techniques and decide whether or not we want to or don't want to do the projects as we go through. So for net present value and internal rate of return, if you could do both projects, would you? And if the projects are mutually exclusive, which one is best? So let's kind of go back. The discount rate is 15%. The net present value for A is $34,000, and the net present value for B is $93,000. According to net present value, you'd want to do both projects because both projects have positive net present values. But if you can only pick one, you'd want to choose project B because it increases the wealth of the company more than what project A does. With respect to internal rate of return, though, both internal rate of returns are greater than 15%. So again, you would do both if you could, but if you could only do one, internal rate of return says that project A is the better project. It has the higher or the highest rate of return. So we've already answered this question about which one ultimately would you do. Another technique that we could talk about is something called the payback period. Payback period quite simply just talks about, it's a measurement of how long it takes for you to get your money back from a project. It's very simple. It's used by a lot of smaller companies, but all companies typically do all of these techniques. It's not like a huge cost in capital to do these calculations. So all techniques are ultimately going to be done. The challenges with the payback rule, though, is it ignores the project's cost of capital and time value of money. It doesn't apply time value of money at all. It ignores cash flows that happen after the payback period. And then finally, it's an ad hoc decision. That is, how do you know whether the project is good or bad? You have to set a benchmark. So if we set the benchmark, in this case, let's say the payback period is 3 years. The project A was 2.0 years is the actual payback period, and we said we won't do anything unless we at least get things back in 3 years. So A is acceptable, but B is not acceptable. So it takes longer than 3 years to get your money back. Again, we know that net present value says otherwise. So there is a challenge with this payback period in that it's set subjectively. There are some other techniques. There's one called the modified internal rate of return. And I like the modified internal rate of return because it helps us solve some issues. And those issues have to do with some of the problems of the internal rate of return number. And essentially this is how it does this calculation. It sets the net investment as the present value, and then it calculates the future value of all of future cash flows invested at whatever the reinvestment rate is, and then whatever that future value is, that's a future value. So we have a present value, we have a future value. We know the lifespan of the project, so the only thing we don't know is the interest rate. So it solves for the return from investing this money and then reinvesting the future cash flows. What's the rate of return of that investment? And as you can see here, again, our reinvestment rate was just 15%, but the modified internal rate of return is 22% for A. That's a good project. It's 24% for B. That's a good project. But it also, if we could only pick one of these projects, project B has the higher modified internal rate of return, so it would be the acceptable project. Now, it's not going to work this all the time. It just, in this case, the modified internal rate of return number is agreeing with the net present value number in its assessment of whether we should move forward with the project or not. What about differences in scale? What happens if you double the size of a project? The net present value is going to double, but the internal rate of return is not. It's going to stay the same. So let's look at a couple of projects here and see if we can work our way through some of these questions. The techniques. Initial investments, $300,000 for the bookstore. Cash flow in year one, $63,000. It's $400,000 for the initial investment for the coffee shop. $80,000 is the cash flow in year one. What's the annual growth rate? The annual growth rate is around 3%. What's the cost of capital? It's 8%. Let's calculate the internal rates of returns. If you calculate them out, you get 24%, 23%. The coffee shop has a higher net present value of $1.2 million. The bookstore is at $960,000. So, what should we do with this project? Should we do it or shouldn't we do it? Should we do both of them? Well, I think it's obvious that we should do both of them. They both have positive net present values, but ultimately, how are we going to make this decision? The internal rate of returns are pretty close, so it's not a huge issue as to which one's necessarily a better number or not, but there is a conflict here. So again, when you have differences in scale, sometimes the projects with bigger cash flows will have higher net present values. There is a bias towards the bigger types of projects. Again, another problem that we have with the internal rate of return is actually the timing of cash flows, even if the scale is roughly the same. So again, if we consider this coffee shop and music store, right, both have the same initial scale and the same horizon, but the coffee shop has a lower internal rate of return, but the higher net present value because it has a higher growth rate. It has a little bit of a higher rate of return. So again, the timing of the cash flows is very important. What about differences in risk? The differences in risk is going to alter the value relative to each other, but once you have assessed and determined what the risk is, the same rules kind of apply. If you increase the size of the project, you'll increase net present value, but you won't change the internal rate of return of the project. So again, if we have another project here, the internal rate of return is higher, even though the net present value ultimately is lower. And the higher cost of capital means that a higher internal rate of return is necessary to make the project attractive. And really, this is sort of what we're going to talk about a little bit in class. It says, well, what are the things that impact cost of capital? What are the things that impact the rate of return that's acceptable on a project? Well, it's risk. So the investors in a company that perceive higher levels of risk are going to want to get paid more when they give the company money. What that implies is that the cost of capital, the cost of financing then for the company, must increase when the risk level goes up. And as the cost of capital goes up, we know the value of the assets goes down. So increasing risks is a detriment to the viability of projects because the value works opposite of the risk level. What about two projects? We just got to decide which one do we want to do. Maybe, it's such a close call, maybe we need to do a calculation. And there is a project here. Here we have these two projects. You can see one's a minor overhaul and one's the major overhaul. Well, which one should we do? We have our cash flow streams here. And of course, we have a cost of capital for both of these is 12%. So what should ultimately the company do? Well, I've input this. There is a technique or a worksheet called project analysis. CB stands for capital budgeting. And if you input project 1, project 2, it calculates what's referred to as the incremental cash flows. It just subtracts them. -10 minus a -50 is 40. And then we do the likewise for the others. 6 minus 25 is -19. And we calculate. Here's the net present value project 1, net present value project 2. The cost of capital, the discount rate is 12%. And it says here that should you do the project, the net present value of the incremental cash flow is negative. If this number were positive, then cash flow 1 or project 1 would be superior. In this case, obviously, it's not. So we wouldn't want to do project 1. We would be better off doing project 2. What are the incremental, the shortcomings of this project analysis idea? Well, first of all, we just have to hope that there's an incremental internal rate of return. We have to hope that there's not more than one answer. These are just typical internal rate of return issues. The fact that the internal rate of return exceeds the cost of capital for both projects doesn't imply that either of those projects has a positive net present value. We don't know that for certain based on the picture of internal rate of returns. So if individual projects have different cost of capital, again, it's not obvious which cost of capital this incremental return should be compared to. Should it be one with the higher or the lower cost of capital? So there are issues even with this internal rate of return rule. The final technique that we want to talk about is something called the profitability index. In this case, you just take the net present value and divide it by the initial investment. Essentially, this is a picture of net present value. It's just rewritten, or the formula is just slightly different. And if the net present value is greater than the investment, then obviously you want to do the project. So if this number is greater than 1.34, we'd like to do project A. 1.46, we'd like to do project B. But if you look in relative terms, which one of these projects gives the biggest bang for the buck, then project B is the project that we'd like to move forward with. So again, what are some of the challenges with this profitability index? And quite frankly, it really boils down to, the resource constraints, right? What is the cost of capital? What is our access to financing in general? As those things become more complicated, the use of profitability index is not as well. And again, we'll talk about these a little bit more in class time. Okay, that's that chapter.